One of the concepts that's most important to understand when doing any kind of financial analysis is this concept of beta. So that's what we're going to talk about today here on Investment Banking Insights. All right. Welcome to Investment Banking Insights. This is the only show absolutely dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason. I'm your host, second year MBA student here at Cornell. Okay, so what is beta? Beta is this concept of systematic risk. So beta, systematic risk. Now, what does this mean, systematic? Well, there's a lot of different types of risk that investors can have in the markets. There's market risk, credit risk, reinvestment risk, interest rate risk, a whole bunch of different types of risk. This just happens to be one of them. And this is the risk of volatility relative to the overall market. So beta is expressed as a number. So this is typically between 0 and 1, but we're going to talk about some other different numbers that beta applies to. So if beta is equal to 1, if you have the stock market going up like that, then your company that you're looking at is going to go up the same amount in the same direction. That's what a beta of 1 means. It's perfect correlation. So now let's talk about some other scenarios. So let's say that you have a beta of -1. So maybe your stock market's going up like that, and then your company is going to go down just about the same level in the same direction as the market, but the opposite. Now, you don't really see betas that are negative like that in the stock market because companies that are part of the market are subsets of the overall market, so they don't tend to move in the opposite direction. You're more likely to see this in other asset classes, like for example, precious metals like gold or something like that. But you typically won't see that with stocks of companies. So let's go ahead and look at a couple of different scenarios now. So let's say that your beta is greater than 1. What does that look like? So if the stock market's going up like that, your beta might look like this. Boom. Might be like a Tesla or an Nvidia or something, right? So your betas, might be beta equals 1.5 or beta equals 2, something like that. You're going to have higher magnitude, but within the same general direction of the market, both up and down. So some stocks will have this beta. And then we also have a more common scenario where your beta is somewhere between 0 and 1. And this is super common in the stock market, especially for businesses that are kind of older, maybe in more mature industries, slower growing. So you may have something that looks like this. And you can see this if you actually chart out the stock prices of companies relative to the market, you'll see these kinds of patterns. So this could be a company like, maybe your Johnson & Johnson, large healthcare companies, or maybe like a 3M or a McDonald's or something like that. You're probably going to find low betas, but positive betas because they're moving in the general direction of the market, just not as dramatically. Now remember what this beta is important for. Beta is important for calculating our weighted average cost of capital. It's important for calculating specifically the cost of equity when you're trying to understand how much it's going to cost a company to raise money in terms of its shares. And that's important for any sort of DCF analysis that you're doing. You're building a model to try to understand the valuation of a company. So that's a breakdown of what beta is, what it can look like, and we'll talk a little bit more about this concept in the future. But for now, that's what I got for you today here on Investment Banking Insights, and I'll see you on the next one. Take care.